Welcome to Cotality's Housing Market Update for December 2025. Our National Home Value Index rose another 1% in November, marking the third month in a row where Australian home values have increased by 1% or more. However, the pace of growth eased a little bit over the month, coming down from 1.1% in October. The headline growth outcome was weighed down by Australia's two largest cities, with Sydney values rising 0.5% in November and Melbourne values up 0.3%. Every other capital city recorded a rise of at least 1% through the month, led by Perth with a solid 2.4% surge in values. These two-speed conditions are similar to the growth patterns seen through late 2023 and 2024, where the mid-sized capitals pulled away from the majors. The subtle easing in headline results comes as auction clearance rates have trended lower since peaking in mid-September, falling below the decade average by mid-November. Both Sydney and Melbourne have seen clearance rates hold around the low 60% range through the second half of November. Record levels of housing unaffordability are another factor, with affordability metrics to the September quarter showing a record high in the national dwelling value to household income ratio, where the median dwelling value is now 8.2 times higher than the annual pre-tax household income. Serviceability metrics are also near record highs, with 45% of gross household income required to service a mortgage at the median value. We can already see the flow-through effect from such stretched affordability and serviceability measures, with growth in housing values skewed towards the lower price points of the market. Over the past 3 months, most of the state capitals have seen housing values across the lower quartile of the market rising the fastest. Melbourne, where housing affordability isn't quite as stretched, is the one exception, with the city's broad middle of the market seeing the fastest lift in values. Rental markets remain extremely tight, with no sign of vacancy rates loosening. Nationally, the past 4 months have seen rental vacancy rates holding close to record lows at just 1.5%, down from 1.9% a year ago. With vacancy rates remaining low, rents are continuing to rise. The National Rental Index rose 0.5% in November to be 5% higher over the past 12 months. That's the highest rate of annual growth since the same time last year. The ongoing rise in rental costs is occurring against a backdrop of severe rental affordability pressures. The latest Cotality affordability metrics estimate that the cost of rent equated to just over 1/3 of a household's pre-tax income in September, a new record high. Now let's take a look at the housing trends across each of the capital cities. Sydney home values rose by 0.5 percentage point in November, well below the combined capitals benchmark, where values were up 1%. It's looking increasingly likely the Sydney market moved through a cyclical peak in the growth rate when values were up 0.9% in August. Since then, the pace of capital gains has eased, alongside a softening in the auction clearance rate, which was tracking in the low 60% range through the second half of the month. It's the upper quartile of the city marketplace that's dragging on price growth, with dwelling values unchanged in November, while lower quartile housing values were up 1%. Affordability and serviceability challenges are likely to be the key factor deflecting more demand towards affordable price points and dampening housing conditions overall. Melbourne is continuing to record relatively soft but positive growth conditions, with home values up 0.3% in November. That was the lowest monthly rise of any capital city. Local housing values have been rising since February, but they remain 0.9% below the record highs set in March of 2022. The silver lining to Victoria's soft housing conditions is that housing affordability is relatively healthy compared to the other major capitals, supporting the highest share of first home buyer activity of any state at 27% of mortgage demand. Melbourne listings have risen through spring, but are tracking 10% lower than a year ago and 6% below the previous 5-year average for this time of the year. Brisbane's monthly pace of housing value growth held firm at 1.9% in November, with the city adding close to $4,300 a week in the median dwelling value through the month. The unit market's continuing to record a stronger rate of growth, with values up 2.2% in November compared with a 1.8% rise in house values. Low supply levels, more affordable price points, and heightened levels of investor activity are all contributing to the stronger growth outcomes across the unit sector. Overall, advertised supply remains extremely tight across Brisbane, tracking 19% lower than at the same time last year and 29% below the 5-year average for this time of the year. The pace of growth in Adelaide home values has accelerated over recent months, with November's 1.9% rise marking the strongest monthly growth conditions since January of 2022, when interest rates were still at virtually zero. Growth conditions have been skewed towards the more affordable price points of the market, with lower quartile values rising 5.1% over the past 3 months, compared with a 3.8% lift in values across the upper quartile of the market. Low advertised supply levels are a key factor keeping upwards pressure on values, with listings tracking 9% lower than at the same time last year and 26% down on the 5-year average for this time of the year. Perth home values surged 2.4% higher in November, adding approximately $5,000 a week to the median dwelling value. Despite such strong gains, the monthly pace of growth eased a little from October, when values are up 2.7%. Low supply levels remain a feature of the market, with advertised stock levels holding more than 40% below average for this time of the year. At the same time, the number of home sales is estimated to be 2.6% above average, demonstrating a severe disconnect between supply and demand. At this rate of growth, we could see Perth's median house value rise above the $1 million mark by January next year. Hobart's housing market has seen a remarkable step up, with values jumping 1.2% in November after a 1% rise in October. The November increase was the strongest monthly gain since January 2022 and follows nearly 3 years where home values have been relatively flat to falling. Hobart dwelling values remain 6.9% below their record highs from March of 2022. It's the lower quartile of the market that's driving the strongest gains, with values up 4.4% over the past 3 months, compared with a 1.5% lift in upper quartile values. Hobart has the second lowest median dwelling value across the capitals at just under $579,000 after Darwin. Darwin housing values are still rising at a rapid rate, with the 1.9% gain in November on par with the October increase to be the highest monthly rate of growth since May of 2021. Both house and unit values are rising quickly, but it's houses where values are rising the fastest, up 2.1% in November compared with a 1.6% rise in unit values. Darwin's also leading the national rate of rental growth, with house rents up 8.1% over the past 12 months and unit rents up a larger 9.5%. A blend of strong capital gains, high rental yields, and tight rental conditions is attracting a large share of investment demand, with investors comprising 49% of mortgage demand by volume through the September quarter. ACT home values are up 1% in November, the strongest month-on-month rise since March of 2022. The rise was entirely driven by ACT house values, which jumped 1.3% in November, while unit values actually nudged 0.1% lower. The unit sector has been recording flat to falling conditions, at least in trend terms, since the start of the rate hiking cycle in mid-2022. Rental growth has seen a moderate pickup, but the annual trend in rents remains around the low end across the capital cities, with house rents up 3.1% and unit rents rising 3.5% over the past year. It seems that housing dynamics are becoming more complex from month to month. Downside factors include record levels of unaffordability, a growing expectation that interest rates will be held for an extended period of time, renewed cost of living pressures, and a fresh phase of macroprudential credit tightening in the form of limits on high debt-to-income ratio lending. On the other hand, persistently low supply levels across both the established market and newly built housing sector are continuing to drive prices higher. The federal government is stimulating first home buyer demand via the expanded 5% deposit guarantee and a soon-to-be-released Help to Buy shared equity program. Credit growth for housing investment is also rocketing, rising at its fastest pace since December 2014. What's clear is the upside factors are continuing to outweigh the downside risks, and it's hard to see this dynamic moving into reverse anytime soon. Time will tell whether this month's subtle slowdown in growth is a reflection of headwinds starting to curtail the housing tailwinds. With housing values rising at more than twice the pace of wages growth, housing affordability is set to worsen. Serviceability barriers are likely to deflect more demand towards the lower price points of the market, with mainstream buyers on a median income crowding out lower-income households at the more affordable end of the pricing spectrum. Stable interest rates will exacerbate the serviceability challenge, with the recent increases to borrowing capacity already eroded by higher housing prices. While borrowing capacity for the median household income has increased by around $55,000 since the high point of mortgage rates, the national median dwelling value has already increased by about $60,000. Over time, rising serviceability barriers are likely to limit the magnitude of home value growth as credit becomes less available. Clearly, APRA is on watch for rising levels of household debt. Any sign of a slip in underwriting standards could be met with additional credit constraints. The recently announced 20% limit on high debt-to-income ratio lending isn't likely to play a significant role in slowing down price growth, but it does send a clear message that APRA is on alert. A more overt policy adjustment, such as lower limits on high DTI lending or a renewed investment credit growth speed limit, if implemented, would have a much more substantial impact, especially at a time when investors comprise around 41% of home lending. Low supply levels will inherently take some time to fix, especially with labour supplies so scarce and ongoing competition for inputs from the public infrastructure sector. Construction costs are no longer rising rapidly, but they're not falling either. Builder profit margins remain compressed, especially across the multi-unit sector. Overall, we're expecting housing values to continue rising through 2026, but the pace of gains is likely to slow down as affordability and serviceability factors put a ceiling on how high housing prices can go. Seasonally, we've already seen a peak in listings activity, and market activity will slow further through December and into January. Cotality will be continuing to publish our market updates, so stay tuned to the insights pages of the Cotality website. As we wind out 2025, I'd like to wish everybody a very merry festive season and a sincere best wishes for the coming year.